picture. We're talking real money.
In a world where real estate prices stay high forever, people are happy. If they fall, people are unhappy. Hi, everybody. Welcome to Talking Real Money. I'm Don McDonald, and guess what we're going to talk about today? Real estate prices. Yes, I know. We're going to tell you some things you don't like, but that's our job. I'm Don. Tom's over there in the Model Military Aircraft Museum looking as good as ever. It looks like the Model Military Aircraft dusting crew came in. Any dusting going on?
Any dusting and these things will come down. They're not that secure. It'll be a dust bomb.
They're
Boom,
held together by little particles of dust and tiny
Probably
little
true.
mites.
Yeah.
Mighty mites.
Right.
Mighty mites.
Don't touch anything.
Don't touch.
Yeah.
We're here to try to help you understand some of the most important aspects of dealing with money, and a lot of those surround this whole process of investing. And one of the things in which a lot of people invest, particularly a lot of millennials, it seems to be the topic of every FIRE discussion. I even forgot what FIRE meant. Financial independence, retire early. They don't even talk about it much anymore. It's kind of like...
You don't hear. I think the FIRE movement burned out or something.
Ooh,
so I say that.
Well, look at you. That was quick. And the thing is that things like the FIRE movement rely on eternal optimism. It really is a bad case of eternal optimism. You see a lot of the younger folks, and of course, being old, that's what we call them, younger, getting all excited about their real estate purchases. And there was a recent article I looked at, and I really didn't think the article was that interesting, but a couple talked about the reason they're making money in real estate, which is really have made money in real estate, is what they call the velocity of money, which us old folks just call borrowing.
Leverage. Yeah, okay, but let's first touch on a couple of numbers before we can get to Mr. Allred and his alleged $30 million portfolio. Because according to a more reliable source called Bloomberg, the value of real estate across this great country of ours, defined by the total value of U.S. homes, declined by $2.3 trillion in the second half of 2022. That's the largest drop in percentage terms since the 2008 housing crisis. It's down about 6%. And by the way, when you saw that, did you run out and sell your house like you would stocks or bonds? Oh my gosh, I'm down 6%. I got to get out of this before it goes down another 10%.
Because most people didn't even read that article.
Oh, I see.
Most people don't, and it doesn't come up on CNBC or there's not a scroll at the bottom of the screen that says
your house,
Don McDonald's home now worth $1.1 million.
Ooh, going down.
Yeah.
So I mean, but this we're really talking about today is real estate as an investment. If you've listened to the show or the podcast, we think residential real estate should be a lifestyle decision. You live there for a reason, not necessarily to make the money, right?
Right.
We're talking today about the people that say, sure, you can make a lot of money in real estate. Oh, this guy's, I think, in his 30s. He estimates his portfolio is at $30 million. I love this quote, and the velocity of money. Here's a quote. Debt is a wealth magnifier. That's the beauty of real estate as long as it creates positive cash flow.
Yeah, now we need to flip that coin. We need to look at the other side of that coin because we as just, single house buyers, not we, but we as in all of us listening to the show, we occasionally get caught up in the same thing. We think because we've got a mortgage and we only put $100,000 down and we've got a $500,000 mortgage and our price, the value of our property rises by $100,000, well, we kind of feel like we doubled our money.
Yeah, which
because
you
our
have not.
Well, you kind of have, but the velocity of money also works in the opposite direction. What happens if the value of your house declines by $100,000?
And you're depending on the rental market, and you're depending on other people to come in and buy that so you can move it into the next deal where you put 25% down.
If your house drops from $600,000 to $500,000 and you only have $100,000 down and you go to sell it, what's your profit?
I'm going to say
zero. It would be zero.
Cost to selling it.
Yes, you have a loss. You see, leverage works. There's an old saying about, an adage about dual-edged swords. They cut both ways. Swords. Yeah.
So, again, this gets back, and I like the fact that you dumped this on the millennials. We're always happy to pick on them because they, of course, gave us cryptocurrency. They raced their money into meme stocks, and they believe that real estate only goes up, which, not true.
Right, not true. I mean, I'm looking at a chart of home prices. Not true.
Tom and Don are talking real money.
Do me a favor. Grab your latest investment statements if you know where they are. How many do you have? A lot? How many different investments are in each statement? A bunch? Do you own individual stocks, bonds, sector funds, and stuff you don't understand? Yeah, I thought so. I'm Don McDonald, and I'm pretty sure you have a case of hodgepodgeitis. But don't worry, it's not terminal and can be cured. But it takes three things: a bit of time, some fiduciary guidance, and a plan. There's a problem, though. Most financial advisors can't or won't provide any of those. That's where we come in. Tom and I will provide you the help you need to overcome hodgepodgeitis in a free, no-obligation meeting with an Appella advisor at TalkingRealMoney.com. So, scan or take a picture of all those pages you gathered, then go to TalkingRealMoney.com, click on Meet an Advisor, and set up a free appointment online or by phone when it's convenient for you. Let us sort through the mess and help you get started on a better, simpler future plan. Just go to TalkingRealMoney.com or call 800-386-3004.
Your guides to a really great financial future. Tom and Don are talking real money.
We're here to put the financial picture of your life in focus, to get it clearer, to try to make this make sense. And every once in a while, we have to tell you things that make people mad. Particularly, and I know it's not a generational thing, but particularly younger people, because, okay. When I was
whippersnappers,
when I was a younger people, I was doing all kinds of stupid investing. Every once in a while, something would go well every once in a while, and then sometimes it would go badly. I mean, I remember distinctly in Colorado Springs, I was a young adult and I was buying real estate in early 1990s. Huh. And the problem was, in the early 1990s, Colorado got hit particularly hard. Not as hard as Arizona, California. This was during the savings and loan crisis in the 90s. And real estate prices in Colorado Springs dropped by 30, 40, 50%.
Wow. Yeah, I mean, you get those locales that really get crunched.
We got killed there.
Yeah.
And I felt it personally. And you learn from it. That's the thing.
Okay, but I want to go, this article, the thing that I really hate about this is that in this case, it's easy. You just keep leveraging up the next deal, right? That's what he's talking about, right? The next one, to the place, I think he said he's in like 1,200 deals or some ridiculous number that are cash flow positive, that are going to make him a lot of money. Yeah, I mean, and as you correctly point out, if he got into a downward spiral like Colorado Springs, wow, I mean, that would kill him. Be over.
It would kill him. I mean, let's think about it. $30 million portfolio.
Yep.
He probably keeps as little equity in the portfolio as humanly possible, and I'm probably being generous when I say he has $6 million worth of actual cash tied up.
Yeah.
Equity. Mm-hmm. So you look at the number, you go, okay, 30 million in a market, a 30% decline like we had in Colorado, was actually a little bit more. Your value goes down to 20 million on the property. Now you owe more. He owes 24 million. You owe more than the properties are worth. Has happened. Okay, wait, let me just go back to 2009 again. Why do we have such short memories? I knew a number of people in my little town here in Florida who were going out in 2007, 2006, 2007, and they were particularly real estate agents. They were buying up properties here like they were going out of style because the prices were just soaring. Sound familiar?
And
then the rug was pulled out in 2008, and a lovely man, a general in the U.S. Army. His wife was they were both successful realtors. They had to file for personal bankruptcy because they couldn't pay the loans on their property.
Yeah, and by the way, for those of you looking at, no, this never happened again, you don't have to look very far, because today there's a thing called commercial real estate, where you're already seeing some of these things creep in, where values of buildings have come down because people haven't returned to work, because companies are downsizing. So there's already some of that going on with commercial property. Whether that means the residential market will follow, we don't know. As I pointed out at the top of the show, it has declined nationwide about 5% since last summer.
And with that increase in real estate prices, we also saw a huge building boom, particularly in residential apartments. They're still being built like crazy in parts of the country. And what that is going to do, and a lot of these landlords don't realize that, but when all of those come into the market and anything negative happens to the economy, because they're all relying on hopefully high rents, luxury apartment style rents.
Yeah.
What happens when the demand for those goes away? Rents will fall. Rents can fall. Now, it won't last forever.
And they're falling here right now, by the way.
And that hurts your cash flow on your $30 million worth of real estate. Now, there's good news. There is good news in all of this.
Oh, good.
By the way, our phone number is 855-935-TALK. There is good news in all of this. If you own real estate for the right reason, residential real estate I'm talking about, for the right reason, as Tom alluded to earlier in the hour, because it's a home, because it's a roof over your head, because it's a lifestyle you enjoy, then all of this doesn't matter, because you're not selling your house.
No, you're living there. That's where you want it. And it might not be your forever home, but it might be for the next 5 years.
But for right now, why do I care if my home, which was $900,000  2 or 3 years ago, went to $1.4 million and is now back down to 1.1 or 2? Why should I care?
You don't. But what you do care about is when you read stories like this that make it sound like this is so easy. That's the struggle I have. This is easy money to be made. All you got to do is leverage up. You do this, this, and this, and you're going to be worth $30 million.
But this big lie persists everywhere. In so many things, in real estate, in cryptocurrency, in all kinds of investment deals, in probably 30 or 40% of podcasts out there about money that tell you that, you too can be a multi-billionaire if you just follow these simple steps, or starting an Amazon store, or whatever stupidity it might be. Making money is never easy. It is never simple, and it is never straight line. Ever straight line.
Well, now you put one word in there that I think is interesting. Simple. I think it can be simple depending on your
maybe simple, but it's not easy. There we go.
Okay.
Because doing the things that are simple can be very hard. Having a simple plan, even that can be very, very hard. And there's only one way, in our opinion, to own real estate as an investment.
That would be in a REIT.
That's right. Yeah. A REIT is right.
You own thousands of properties, because some will go great, some will be okay, and some won't do very well at all. That's just, and we don't know which ones.
So in other words, we're all right with REITs.
I'm not all right with Dave Allred, because, again, I don't trust him, and I really don't trust the number. Some of the numbers they had in this article as well, about how easy it is to take your 75% loan to value all the way down to 60 in just a few years with appreciation.
Oh, wow. Seriously? In a few years?
Pretty quick. That's what it said.
Well,
a few years.
Okay, that can happen when you have an increase in prices like we had in 2007. That can happen when we had an increase in prices like we had in 2021.
Yeah, right there. Sure.
That can happen, but it only happens in these brief windows. And to get in at the right point in that window, to buy at the very right window of that window, and then to sell before that window closes and crushes your fingers,
And by the way, in addition to the timing, it's location. Because on the coast, you've had some of this. In the middle of the country, not so much. I mean, you look at prices there that do not move very much for long periods of time.
As a matter of fact, that was one of the reasons why we moved to Virginia or bought a house in Virginia for a little while. And the prices don't move much. They haven't moved down much, but they hadn't moved up much. They just stay there. But it is in places like Florida, Arizona, California, Washington State, New York to some extent, the Pacific, or the Northeast to some extent, beaches always, some mountain areas, Colorado.
Beach sounds so good right now. Just to be warm again.
Tell you what, I'm only an hour drive away. If you want to just hold down the fort for a minute, I'll drive over to Cocoa Beach so you can just see it while we do the show. 855-935-TALK. Give us a call.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Once again, our telephone number is 855-935-TALK, 855-935-8255. If you call us on that, we'll try and help you manage money issues and figure out the best way to do things and help you build that simple plan that's really simple, just, again, hard to actually pull off. 855-935-8255. But we also take your questions online at talkingrealmoney.com, and sometimes you type them in. And Tom gets those.
A lot of them. Yeah, by the way, we got a lot of nice comments for Retire Meet 2023, which was last week. And by the way, I think that's available as a video soon.
No, it's there.
It's already up there?
I watched it. It's not really an edited thing. It's just the replay of the whole thing, I think. I can't really tell, but it's it's re-streaming.
Okay.
Because there's all the time when nobody could figure out where the professor was coming in. So,
yeah, well, I was on stage going, I think he's coming out. I'll keep going until he does. So anyway, thank you for joining us.
And by the way, the professor we refer to as Professor Phineas Feinstein, who was actually the real inventor of financial physics, not that guy Don McDonald.
Yeah, that imposter. This question comes from Michael. Says, I'm 62 and plan to retire from my current job next year. Should I be in the market at all since I plan to start drawing from my retirement savings? I understand that putting money in the bank will not keep up with inflation. I have mutual funds, no single stock. Should you be invested in stocks after you retire?
Yes.
Oh, okay.
Yes, you should, because you just said it. Fixed income isn't going to keep up with inflation. It never has. You know, we get all excited. Oh, I remember those rates back in the 80s when I could get like 15% on a CD. Well, Dad, do you remember that the inflation was running at 20?
Kind of a small problem there.
Yeah. No, as a matter of fact, I don't know that there's ever been an extended period in history where safe fixed interest rates, I've never seen it. No, where safe fixed interest rates have been higher than the rate of inflation, because it doesn't.
No, I'd have to think that through, but no, I don't. I think you're right. Okay, but back to Michael's question. You're retiring. What should your balance between riskier things like stocks and less risky things like bonds be? And that requires the thing. Yeah, well, that's what he's really asking. So that is a very important question, and one that refers back to something that was mentioned at Retire Meet last weekend, and that is called the PLAN plan. Because if you have a plan that says, yeah, I'm going to take Social Security here, yeah, I got a pension here, I need to start drawing my portfolio here, and here's how much risk I need to take to sustain myself, to have it grow enough so that I can pull the money out, then you don't have to have any of this guesswork around what my, how much here, there, and everywhere else is. It goes away because you have a plan.
Right. Now, bear in mind, within the plan, there always is a modicum of guesswork because we're predicting the future.
Oh, sure.
But the plan helps make the process easier and clarifies the needs. That's really the thing about a plan. Most of the time when we sit around as investors and try to figure out what we want to do, we have no clarity. And that's why we always hear the question, well, what should I do now with this money? Because we just don't have a clue.
And people want to know that question first before they go back to the previous part, right? I just want to know what to do with the money. Well, that's part of it, but you got to know the rest of it first. So back to your question, should you be in the market at all? Yeah, retirement is generally longer than a year or two, could be as many as, 30, 35 years. So you need, as Don just correctly pointed out, something to guard against inflation. That has not been bonds, that has not been money in the bank, that has not been CDs, especially in a time now when inflation is running at, 6%. So you need to have something. And Michael, back to overall, you need to have kind of a plan that says, here's how much I need to make, not how much I want to make, but here's what I need to make to sustain my lifestyle.
And that is actually a pretty easy question to answer, particularly, though, if you sit down with a professional. But remember, the professional is never someone who sells product. That's not the professional you want. But you need a plan. Plans are critical. It's the most important part of the process. Nothing is more important than the plan. Everything must start with a plan. And I know that sounds really boring and no fun whatsoever. But once you get that part done, the rest is a lot easier.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
And you're invited to talk that real money stuff with us. I'm Don. Tom's over there. Okay, we're 3,000 miles apart, but he's still right there. I'm looking right at him. So as far as I can tell, it's kind of like looking at him through a magic window. Or a magic mirror.
Kind of a magic window.
It's like a magic mirror. Yeah. Remember Romper Room and the magic mirror?
Oh, of course.
Yeah, no millennial does. That was way before.
I got thrown off Romper Room for being too crazy.
I was on the Bozo the Clown show in Chicago.
That does not surprise me.
I was okay. I was in the audience for the Bozo
I don't even want to.
show.
Okay, audience. Okay, I'm better with that.
Audience.
So, all right.
The one on, I think he was on WGN in Chicago.
Wow. Flamethrower.
Yeah. It was television.
Okay.
I don't know if the television tower throws flames too.
No, I don't think so. That's an AM thing.
Sort of a fizzle.
50,000-watt flamethrower.
Yeah. In the days of that, by the way, if you're thinking about investing in AM radio, think again.
Oh, good Lord.
Think again. I have a prediction for AM radio. I don't predict a lot of stuff, but you remember what happened to television not too many years ago? They switched all of the TV stations that broadcast over the air. They switched them to digital UHF channels.
I remember.
From the VHF. Remember, we used to have VHF and UHF, and you click the little
very
knobs,
high frequency.
And ultra high frequency. You click the little clicker from channel 2 to 3 to 4 to 5 to 6. Those were real clicking between these frequencies. And they took those frequencies, channel 2, channel 3, channel 4, all of those. They took those frequencies and basically sold them to T-Mobile.
And now they're being put to good use.
As 5G.
Yeah.
That's so my prediction is that AM is going to meet a very similar fate.
And by when?
The timing is tricky, but but my guess is that because go get a new car and see what kind of radio they have.
Did you see the piece in the Journal the other day that the broadcasters are pushing, I think it's Department of Transportation, to make sure that they require cars to have AM radios in them because of the EBS system.
I got to tell you, do you know what's more efficient than the EBS system, in my opinion? I mean, if every single, when you ever gotten an Amber Alert in a group of people, it's like the whole world turns into a giant beeper. So apparently they can give really good alerts on your phone.
I'm just telling you what they said.
Of course. Well, let's see.
An odd way
National Association of Broadcasters trying to protect broadcasters. Yeah. Oh,
got it.
That sounds like the National Education Association trying to protect teachers, or the Teamsters trying to protect truckers. Yeah, makes sense.
You get the point.
855-935-TALK. That's our phone number. Give us a call. And we'll try and help you deal with all kinds of money issues, like, interest
making
rates.
Money.
Like making money. Do you remember rates used to be weren't rates last year zero?
It would basically, about a year. Yeah, about a year. It's crazy.
It was about a year ago.
So when someone wrote me today and said, should I invest in stocks or should I just put it in a CD? I thought, well, that's kind of a crazy notion. I decided to go take a look at bankrate.com to see what CDs are paying now.
Mm-hmm.
I almost fell out of my chair, which at my age is not a good thing. You can get an 11-month CD at Capital One for 5%. Oh. 5%.
Oh, Tommy.
Wow. Oh,
you know where you should have gone?
Oh,
I actually went. I have an account at Schwab.
Yeah, okay.
So I signed in and I went to. It's right here at the top. The Schwab. Schwab has a fixed income rate page. Holy cow! A 1-year CD. Well, let's start with a 6-month CD. 5.06.
6 months.
1 year. 5.3.
Ooh.
2 year. 5.35.
So basically the same.
Here's where things get weird.
1 to 2.
3 year. 5.15.
So wait, so you make less for giving your money longer?
Yeah.
That does not make sense.
It's the inverse yield curve thing. It's really wacky. I mean, U.S. Treasuries. A 2-year Treasury is 4.92, but a 3-year is 4.59, and a 4-year is 4.41, and a 5-year is 4.28, and a 10-year. How
much on the 10? Is it under 4? I think
3.97.
Yeah. That's what we call inverted.
So this is really inverted.
Here's the question, though. Okay, and I don't believe in, and we'll talk about this coming back, but should you have stocks or CDs? Nothing to compare there. But should you have CDs, bonds, or high-yield savings? There's something to talk about there.
Ooh, and the world has changed there. It has changed a little bit. It depends on how simple you want it to be.
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Our problem, Tom.
Yes?
Is we're just too much fun to listen to.
No one wants to interrupt?
They don't want to interrupt with a phone call. You know, it would be rude.
Like
it does. It feels almost like it's rude to interrupt with a phone call. Okay. Does anyone ever interrupt your home with a phone call anymore like they used to?
No.
Pretty much not. Does anybody call?
My sister calls.
Okay. Does anyone call who isn't really old?
Good point. Has anyone under the age of 40 called?
Yeah.
Like 40. I got to think that through. Not really. My daughter, no. My son, not so. Probably not. Yeah, I guess not. So, okay.
Well,
you're making me feel bad.
Well, don't feel bad. Don't feel bad, folks. Don't feel bad for Tom because he's actually just AI, as you could tell by that last thing. This is what ChatGPT sounds like if you give it a voice. And so that's what happened to Tom's voice.
Help us.
ChatGPT. I was talking to ChatGPT the other day.
Yeah.
And it gives really generic. I asked it some questions about money and stuff. I think one of these days I'm going to do a podcast where I just have a conversation with ChatGPT. And what I'll do is I'll take the ChatGPT responses and, of course, digitize the voices like yours is being digitized right now by Comcast, Xfinity.
You like that sound? Yeah.
It's a cool little effect that they give you. And by the way, Comcast throws that in at no extra charge. They will cause your voice to sound like a digital robot, no extra charge. Because Comcast has this horrible system. Comcast cable internet system, just for those of you who don't know, in many parts of the country, is like the old-fashioned, and I'm really going to date myself now.
Nobody else will.
The old-fashioned party line.
One person picks up, another person picks up, and then the next thing you know, everybody's on there.
In the olden days, you could get a regular phone line that was private, but boy, that was pricey. That was the big buck phone line. Or you could share your phone line with your neighbors for less money. Because
you don't want to have too much of a quiet conversation on that one.
Who wants to? And you would literally just pick up the phone and your neighbors would be talking. I remember it as a tiny child. That we were really poor and we had a party line. And I also remember, boy, could you get in trouble if you made a long distance phone call? In those days, long distance phone calls were like
a lot.
dollars per minute.
Yeah. See, when you say party line to me, I think of the 1970s takes on a whole different meaning, but that's just me.
Oh, I forgot. Yeah. Yeah, it was you were the there's a movie about you. There's a movie about you. There's a movie about you. It's like what is it?
There is.
Cocaine Bear or something?
Not hardly. Okay, let's take up this question because it has come up a lot. Well, this whole where do I put my cash or cash?
I know it comes up all the time.
And so it's a fascinating. You mentioned you went through some of the rates for CDs. High yield savings
wait,
right
hold
now.
on. Can we come backwards for a second? I went to check out because I was looking at CD rates and I was seeing some nice 5 rates at Schwab, at some of the banks like Bread is paying 5% on CDs, a lot of, and so I wanted to compare them to Wells Fargo, Chase, and Bank of America.
Bank of America, sure, yeah. The customer leaning
coming
corporation.
In behind the 5% rates, coming in among those 3 competitors, coming in at second place, place on their 1 year, 2 year, 3 year, 4 year, 5 year CDs, coming in exact same rate on all those CDs, coming in second place. Ladies and gentlemen, Bank of America at 0.03% per year.
Oh, good Lord.
Third place, Wells Fargo at 0.015. And bringing up the rear, J.P. Morgan Chase Bank at 0.01% on any CD you buy from them.
And Dollars to Donut says that they hold 80% of the assets in this country that are in bank accounts that are paying less than that. Right? They're paying 0.0.
Why?
0.000.
Why would you walk into your Bank of America branch?
They're nice people. And nice.
Give them money for a CD at 0.03% when you can't even walk up to the little window on the vault and look at the money. There is no viewport on the money.
I only put my money where I could see it, Don. I don't put it out there in them crazy online.
Yeah.
Because the young man behind the counter is very nice at Bank of America. Very nice.
All right, back to the question. So what should I do? I'm an investor. I'm looking for a place for my cash.
Yeah. Because here are the numbers.
Do I go bonds or do I go? Yeah. Go ahead.
Yeah, the SEC yield on BND, the total bond, is 4.39.
Okay, that's good.
And it's about breaking even for the year in terms of return. And then you got your high yield savings. I just started to mention Lending Club will now give you 4%. And then you piped in with some of those great CD rates. I had the 11-month at Capital One, but you went to Schwab and found over 5% on those CDs.
Well, and then I looked at the bank I've used because their rate was so great. I can get a high yield savings, which I wanted because this was for money, emergency money. If something happens, I need immediate access to it. I'm getting 4.25 on immediate magic money when that's about the same rate I'm going to get on BND, which is an intermediate term bond fund.
And my take, by the way, on the difference between this is I don't hold bonds for yield.
There you go.
most people, that's not why they're in my portfolio. Mm-hmm. They're in my portfolio to give it stability when stocks get crunched. Now, I know that didn't happen last year. Okay, I'm fully aware of that. But in a general sense, they provide the ballast while stocks do whatever they're going to do, up and down.
Yeah, and the thing is that when you have an intermediate term bond fund, it's kind of like trying to get the best of both worlds. The higher traditional yields of a non-inverted yield curve, which we don't have right now. I know it's all very confusing, isn't it? It really is. It makes my head spin. And I do this for a living. I know this has got, you're going, what? Wait a minute. Yeah. It used to be that I get 3% on a 1 year, 4% on a 2 year, 5% on a 3, 10% on a 10. Yeah. But now it's the exact opposite.
It is very odd. And again, back to the bonds versus savings versus CDs, it should depend on the purpose of the money. This is the part that people forget. I just want the best deal. Well, but do you need the money in 6 months? 6 years, I mean, whatever it is. And then the bonds, really, that should be in a more traditional portfolio, as I say, for balance between bonds and stocks.
And that brings us right back to the 4-letter word that we uttered earlier in the show. The 4-letter word being plan. How do you know which assets should be in which type? The only way you're going to know that is through the creation of a personalized income plan that will become a personalized investment plan after it's a personalized income plan. That should also have a personalized tax plan as part of the plan, because you need a plan for all of these parts and pieces of your financial life. And once you have that plan, then you can always look back at that plan and go, oh, the plan tells me to do this. Now, plans live and breathe. You change them once in a while. 855-935-TALK. Call us.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Now, we talk about you and your financial life here, and we try to help you make better investments, but the one thing we can't do is go in depth. For example, we can't sit here on the radio and help you start at least a basic plan, but we can if you let us meet with you. And Tom takes these meetings all the time.
You know, I enjoy meeting with, I had a great conversation with a fellow down in Houston this morning about his situation, his family, and I absolutely love it. But it's always a conversation. That's where any great advisor should start, about what you're trying to do, where you're headed, and then how somebody could help you.
Yeah, and the conversation usually should take some time. And within the conversation, there should never be a product pitch or even a sales pitch for that advisor services. And you can just set yours up. Go to meet an advisor at talkingrealmoney.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Are we done now?